while we qualify valid order blocks or high probability order blocks with fair value gaps, sometimes an order block will form a down close candle near an important key level from a higher time frame level, and that down close candle may not necessarily have a fair value gap. So we're filtering that with any down close candle that was at the beginning of a initial expansion price swing. Then it has to be retested. We are then looking for the fair value gap. Before I get into it, I want you to understand certain things here. I've taught you how to qualify, in my definition, a high probability order block. They are coupled with a fair value gap linked directly to the candle. This model is not suggesting that at all. What we're doing is showing you how to find fair value gaps in the middle of price runs. The question is what gap do I use? Now notice this down close candle right before this big move here. There's really an absence of any fair value gap. Now does that make that a low probability order block? Well, in terms of my definition, yes. In an ideal world, we want to see this down close candle create some kind of a gap here. There isn't one because this comes down, closes any likelihood of a gap. Watch what happens. The price comes back down, slams into the order block, the highest portion of the candle, or the high, to the midpoint or mean threshold is what I'm highlighting here. Now, in full order block theory, we would use the entire candle, but I like to use the upper portion because that's where the most sensitivity is going to be. So price trades down into it. Even at this moment here, I don't have to be a buyer. In fact, I don't want to be a buyer there with this model. What am I waiting for? I'm waiting for the order block to prove there is expansion. Okay, so there's an expansion swing here, taking price higher. Inside this price swing, there's a fair value gap right here. So all it needs to do is trade to this price or lower, and we could be a buyer there. This is the order block fair value gap coupled for this model. So the distinction is we want to see price show a willingness to want to rally. Why is this pattern powerful? Why is it even being mentioned? Why does it have its own model? The reason is this. Smart money bought down here. I may have missed that. You're going to miss it. Okay? Price comes back down into it. I may not still see it here. But if I see price react and it creates an expansion move here, I can see that the narrative is, okay, they bought here off the order block. They did a huge accumulation of orders here. The expansion move, I go inside of this range here and find where's the fair value gap. Well, there it is. Which gap do I buy? That one. Using model number 12, this is what you're looking for. Price drops down into the fair value gap here. We know that there's a displacement here and there's a displacement here. They have kept price in a relatively small range. Small ranges bring what? Large ranges. As a scalper intraday, you want volatility and you want directional impulse. This is what you're looking for. Let's look at another example. Now, last down close candle. No fair value gap to speak of in here. Price creates a impulse swing. I may miss it. I may second guess this. I don't know what's going on. It's got double bottom formation here. We know there's a likelihood of what? A potential stop run. So I'm not having this really on my radar yet. But watch what happens. Price drops down into the order block. And then we have expansion. My eye goes inside this range and I want to see where's the fair value gap. There's the fair value gap. And yes, in this sense, we do have the high probability order block with the down close candle with a fair value gap. So right away, you know this is the likelihood of a potential bullish order block. But if you would use that theory, would you have gotten filled on this? It never got down there. But model 12 gives you the entry pattern. Fair value gap here. There's your entry at this candle's low or just below it. Beautiful 20 pip expansion and well beyond. Relative equal highs. Bread and butter, give me 20 pips, thank you very much. Next example here. Up close candles here, all one order block. Price trades down, comes right back up into the order block, and then we have an expansion price swing lower. So my eye looks inside this range here. Where's the fair value gap? This one down here, think in terms of your PD array matrix. The high to this low, split it in half. It has to go above or at the 50% level to get to a equilibrium or premium level. That would be filtered for this right here. The fair value gap is here, would be your fill. And the shaded area constitutes a 20 pip run. All you're looking for is that 20 pip bread and butter setup. That's the protocol. So we're not forcing a perception of, okay, I want to look for every potential fair value gap and I'm going to trade it. No. Certain things have to happen in a series of or a specific order. Then an outcome should be reasonably expected. It gives you perception. It gives you depth of understanding about what you're seeing in terms of price action at the moment and not just guessing, because there is a logical theory behind why and where price reacts and trades from. This actually has another example here that I didn't have, but as I'm talking to you, I'm looking at it right now. I went right to it. We have the last two up close candles here. Price trades down away and comes right back up into the bearish order block. Then we have what? Then we have an expansion swing. Fair value gap right there. There's your fill. From here to here, there's 20 pips. Many times you're going to catch it after it does this, where it starts to run. This is the reason why I say we don't chase price. We do not do it, because there's going to be a procedure that will allow you to get into the marketplace at a fair value, hence fair value gap, and that's what's happening here. Okay, our stop would be above here, but we are allowing, with money management, to endure, if you will, any closure of that gap. And the gap may just close and that's all there is, or it may go to consequent encroachment and that's all there is. Price create an impulse price swing. Price comes back, trades into the order block here. Now we want to see what? We want to see the expansion price swing here. The impulse price swing is the initial displacement. The retracement is the retest of the order block. Then the expansion move, where price really starts to get accelerated, this is where we do not chase it. We just simply wait for the fair value gap to form right here. Okay, we wait for price to come back up into this candle's high, which is the fair value gap's low. Your short entry is there, and 20 pips is just the shaded area, and it does a whole lot more obviously here. Now, in closing, some of the things that make these setups better or higher probability is obviously what is the directional bias in institutional order flow on a daily chart. If you're trading in that direction and inside of a kill zone and this pattern forms, man, is it a loaded deal.